Good evening. Please come to IFRS 10, a very important standard. Now today is very important topic, consolidation procedure. So consolidation of an investee shall begin from the date the investor obtains control of the investee and cease when the investor loses control of the investee. So what is the date from which consolidation begins? Date you acquire control. So we have discussed about control in the previous lecture. We had also discussed about control in IFRS 3. And you will consolidate up to the investor loses control over the investee. What do you mean by consolidation of financial statement? It means combine like items of asset, liability, equity, income, expense and cash flow of the parent with those of its subsidiaries. So what you have to do, you are given the financial statement of parent and subsidiary. This is SOFP. So basically you have to add assets with assets, liabilities with liabilities, income with income, expense with expense and cash flow with cash flow. Of course, certain adjustments would be made. For example, in the parent balance sheet, investment in subsidiary will appear. This will not come in the CFS. This will be cancelled against share in the net asset of the subsidiary. In the process of consolidation, this gets cancelled against the share in net asset on the date of acquisition. So that will not come. In its place, goodwill may come. Okay. In case the calculation suggests that you had paid goodwill, or in place of that, gain on bargain purchase may come, which may be added to the profit and loss. In case if you are holding less than 100%, since we are going to consolidate 100% of the assets and liabilities, and if you are holding less than that, let us say 80%, 20% belongs to other. But we are taking over 100% of the net asset. So that 20% value of the net asset of the subsidiary will be presented by a heading called non-controlling interest, indicating what is the value of outside parties in the net asset of the subsidiary. So this is a basic discussion of consolidation procedure. Offset or eliminate the carrying amount of the parent investment in each subsidiary. So parent investment in subsidiary will not appear against the parent's portion of equity of each subsidiary by applying IFRS 3. Then eliminate in full. Next transaction, very important, but this is an easy adjustment. Eliminate in full intra-group assets and liabilities. Since we are preparing the group SOFP, in parent's book, due from S Limited may appear. In subsidiaries book, due to parent may appear, correct? But now if I am preparing the group financial statement, does it look nice to show due from S and due from P? They are same party now. It is as if it is one entity. So this we will eliminate. Intra-group asset, liability, equity, and if I am preparing statement of profit and loss, income and expense, like interest paid by one group entity, to another group entity will appear as income and expense. Eliminate. Sale purchase, we will eliminate. Dividend paid and received. This dividend I will discuss separately also in a separate heading, dividend or any such expense. Similarly, in the cash flow statement, cash flow between group entity will be eliminated. Profit or loss. Now one more thing we will do, which we will call elimination of unrealized profit or loss. When parent sells to subsidiary or subsidiary sells to parent, either inventory or PPE, either inventory or PPE, then in that case, if the stock or the PPE remains unsold, it means it may include unrealized profit or unrealized loss. Now, if I am preparing the group financial statement, cost to A is 100, sold to S at 200, and if S has not yet sold, it means the inventory will be now valued at 200. But from the group's perspective, the cost was 100. So we have to eliminate the unrealized profit from inventory, and in some questions, it may also be property, plant and equipment. Again, in a separate heading, I am going to tell you how to do this adjustment. Intra-group losses may indicate an impairment that requires recognition in the consolidated financial statement. So in case of losses also, we have to eliminate the unrealized loss. But if the loss is genuine, then we don't reverse the loss. In case of loss, if the loss is due to impairment or fall in the value of the asset, then we do not reverse the loss. Because in any case, if I am preparing group financial statement and if the value of the asset has gone down, I have to recognize that loss. What about income tax? IS2 will be applied. When you eliminate the unrealized profit or loss, a difference arises between the carrying amount and the tax base. Is it right? Suppose inventory was appearing at 200 rupees. But in consolidated financial statement, what we do? We eliminate the unrealized profit. So carrying amount of the inventory is reduced. But for tax base, we don't do this adjustment. Tax laws will say, oh, subsidiary has purchased at 200. So subsidiary will be allowed a deduction of 200 whenever this inventory will be consumed or sold. If nothing is given in the problem, for elimination of unrealized profit, you have to also create DTA. What you will create? DTA, because carrying amount is lower than tax base of an asset. Refer IS 12. Carrying amount is lower than tax base of an asset means DTA will arise. Because your tax base is high means more deduction will be allowed in future compared to books. So DTA. Same thing for property, plant, equipment also. Next point in consolidation, which the examiner will check, your calculation of non-controlling interest. Share of non-controlling interest in the profit and loss. If I am asked to prepare profit and loss statement, and if I am preparing the SOFP, in case the parent does not hold 100%, then I will also be required to compute the NCI in the net asset of the consolidated subsidiaries and will be disclosed separately, right? How to calculate NCI? Issue of NCI will arise when the subsidiary is not wholly owned, that is not owned 100% by the parent. A part of the net asset belong to non-controlling interest shareholders, and that is called NCI. The standard 103 gives you the formula for calculating NCI on the date of acquisition. NCI on the date of acquisition can be either based on fair value or proportionate share in the net asset of the acquiree on the date of acquisition. Is it right? So I have given in detail line by line how will you compute NCI, because in this chapter you may have to do this exercise. So measure NCI at fair value. What you'll do, first calculate how many shares are not held by the acquirer, or you can say how many shares are held by the non-controlling interest. That they will give you in the problem, into market price prevailing on the date of acquisition. Market price of which company? Acquirer or acquiree? Market price per share of acquirer or acquiree? So write acquiree. Because to confuse you, they give you two market prices. NCI will be based on, if the problem is silent and fair value or the market price of the share of acquiree is given, take that. Second, measure NCI by calculating the share of fair value of net asset acquired. Two options are given in IFRS because there was no agreement among the members of the IASB or the people who had given the comment at that time which method should only be used. So finally they have allowed both the method because they could not arrive at a consensus on only one method. So one is proportionate share in net asset method. Now how do you compute it? So on the date of acquisition, you will compute the fair value of the net asset of the subsidiary. Fair value means also take into account any change in the value of any asset or liability. You will also consider any intangible asset which may not be there in the books. You will also consider any deferred tax asset or liability. So first you do all adjustment in the net asset of the subsidiary and then multiplied by NCI holding percentage. How do you get the fair value of net asset? Fair value of all identified asset minus fair value of all identified liabilities. If suppose you have to use this route, asset minus liability route, even if some asset may not be appearing in their books, but if it is separately identified like brand, patent, may not appear in the books of the acquiree, but may be separately identified by the acquirer, then that will also be considered. And you will also consider DTA and DTL on the assets and liabilities of this subsidiary on that date. If that route is not possible, then you can apply this route. Share capital plus all the reserves of the subsidiary on the acquisition date and plus fair value adjustment on acquisition. Fair value adjustment, if the book value is 1 lakh, fair value is 2 lakh, add 1 lakh for that item. In case of assets, increase in value, add, decrease in value, less. In case of liability, increase in liability, less, and decrease in liability, add, decrease in liability, add, gain. Okay, so then you will get the answer. So we can solve by either of the two methods. NCI will be first computed on the date of acquisition as per IFRS 3. Subsequently, what you will do, very simple, we'll follow this trick. We will write NCI on DOA. What is DOA? Date of acquisition. Okay. And to that you add, sir, what we will add? Any change in the post acquisition profit, loss, or any other component of equity multiplied by NCI share. Okay. add NCI share in the post acquisition change in the net asset. Can I say that? Add NCI share in the post acquisition change in the net asset of the subsidiary, and that you add, that will give you NCI for closing SOFP purpose. NCI will be disclosed in equity only, but separately from owner's equity. So you will write it as a separate line item in the SOFP, since it represents the residual interest in the net asset of the subsidiary, and also it is not a present obligation to the entity. NCI are like shareholders only, they are not liability. So it is not a part of non-current liability. It is a part of equity because it represents the stake of outside stakeholders in the subsidiary, okay, net asset. Now we'll solve a small question there. First we'll do some warm-up exercise, okay, before the match begins. A Limited acquires 80% of B Limited at a valuation of 150 crore by a payment in cash of rupees 120 crore. A Limited acquires 80% of B Limited at a valuation of rupees 150 crore by payment in cash of rupees 120 crore. So what is the total value of this subsidiary? 150. 80% you acquired, hence you paid 120 crore. Now in this question, if they ask you calculate the value of NCI using fair value method, so your answer will be 150, the total valuation of the subsidiary, into 20%. Is it 30 crore? Is it written in your book also? Say yes. Yes. Now suppose I continue with the previous example. Assume that the value of the recognized amount of subsidiaries identifiable net asset is 130 crore as per IFRS 3. Now compute the value of the NCI. So if I have to use net asset method, the value of the NCI will be 130 into 20%. Haji, is it 26 crore? Yes. So that was about how to compute NCI, but this was oversimplified. Now let us come to goodwill calculation, which in short means we will have to revise which standard? IFRS 3, because this standard does not teach you how to compute goodwill on the date of acquisition. That is the job of IFRS 3. After you calculate goodwill under IFRS 3, then goodwill is not amortized. Goodwill is only tested for impairment annually. And if it is impaired, then we'll provide for impairment loss. So this may result in either goodwill or gain on bargain purchase. So let us see how to compute it first. Goodwill is the excess of A over B. What is A? A is aggregate of amount of consideration transferred, measured on the date of acquisition fair value. Okay, already discussed with you in IFRS 3. Take fair value of consideration transferred. First line is fair value of consideration transferred. To that, you will add NCI, either at fair value or at proportionate share in net asset. Third thing you will add, if applicable. Okay, this point I will explain right now only. Afterwards, we will not have to discuss. Suppose you have already acquired some stake earlier. That is called business combination achieved in stages, or also called step acquisition. Then I will also add the fair value of the previously held equity interest in the acquiree. Suppose earlier I was holding 20%. Now I have acquired 40%, which means I have got the control now. So this standard consolidation will start from this date. That is the date you acquire the control. Now what I will do for goodwill calculation, I will take the fair value of this 20% stake. Okay, we have discussed in previous chapter IFRS 3 also. We will take 20%, that is the fair value. So what is NCI here? 40%. NCI 40/20. So this is the 100% value of that company. So it will be compared with 100% of the net asset also. So we'll compare with net asset on the date of acquisition. So what you should do before you solve the goodwill working note, you should first calculate what is the net asset on the date of acquisition, because that you will require for calculation of goodwill. A is greater than B. What will you get? A is greater than B, goodwill. B is greater than A, gain on bargain purchase. GOBP, gain on bargain purchase. Is it right? So write down one example, solve. Gain on bargain purchase means you paid less, you received more. What an idea. You paid less, you received more. How is it possible you pay less and you receive more? Maybe somebody wants to sell his business and wants to raise funds. So he might sell you at a lower value. Is it right? Sometimes somebody may be in distress situation. Government wants him to pay money, otherwise the chairman would be put behind jail. So what that companies do? Those companies sell the assets at a lower value. So whatever may be the reason, we got the benefit. As per this standard, gain on bargain purchase is our profit and will be recognized in profit and loss account. Profit and loss. Let us go to first method. Do you remember the first method? NCI problem. Example 1 at the top. Calculate goodwill for that problem. In that question, example 1, same page, A Limited acquires 80% of B Limited at a valuation of 150 crore by payment in cash 120 crore and NCI was 30 crore, correct? And what was the net asset in the example 2? 130 crore. So can you calculate goodwill in this example 1? 120 consideration paid, 30 NCI minus net asset 130. Therefore, goodwill 20. Tick mark. But if I apply method 2, what will be my answer? 120 I paid, but the NCI will be valued at 26. 120 plus 26 minus 130. How much is that? Is it 16? This is called full goodwill. This is called full goodwill. And what is this called? Partial goodwill. If the goodwill is impaired in this method, then impairment loss will be borne by NCI also. Will be borne proportionately. Okay. But if it is partial goodwill, NCI will not bear impairment loss. NCI will not bear impairment loss. Now write down journal entry. Suppose you have to pass journal entry on the date of acquisition in first method. fair value method, write down entry, net identifiable asset account debit 130, goodwill account debit 20, to consideration payable 120, to NCI 30. To NCI 30. Okay, now you try method 2. Net identifiable asset account debit 130, goodwill account debit 16, to consideration 120, and to NCI 26. To NCI 26. Below there is one example 3. In the aforesaid example, if the consideration is 90 instead of 120, then the amount of bargain purchase is 10 crore. The amount of bargain purchase is 10 crore. Is it true? Why 10 crore? Consideration paid 90 plus NCI was how much? 30. And net asset acquired 130. So minus 10, bargain purchase. Whereas as per method 2, 90 plus 26 minus 130. How much is this? 14. So let us quickly write the journal entry again for these two situation. Little fast. Come on. Net identifiable asset account debit 130, to bargain purchase 10, to bargain purchase 10, to consideration payable 90, to NCI 30, and then write down method 2 also, proportionate share method. Come on, fast. Identifiable net asset account debit 130, to bargain purchase 14, to consideration payable 90, and to NCI 26. To NCI 26. Only in the exam don't write NCI. Okay. Next question, problem number 1. Raja purchased 60% share of Ram Limited, paying 525 lakh. Number of issued capital of B Limited. Why B? Make it Ram Limited. Number of issued capital of Ram Limited is 1 lakh. Fair value of identifiable net asset of Ram Limited is 640 lakh, and that of the liability, so you have to take the difference, is 50 lakh. On the date of acquisition, the market price is 775. Find out the value of goodwill. Now here also there are two answers possible, fair value method and share in net asset method. So first let us write down case A. Write there heading case A, and CI is measured at fair value. I have drawn the format, fill in the blanks. Fair value of the consideration paid, write down there 525. Okay. Fair value of NCI. If you are taking fair value, take 40% into 1 lakh into rupees 775. 310. Take total 835. Fair value of identifiable net asset. 640 less liability for 50 INA, identifiable net asset 590, therefore goodwill 245. Dear student, try the second one. When the NCI is measured at proportionate value of net asset, fair value of consideration paid 525, but the proportionate value of NCI 40% of this 590. Is it right? How much is that? 236. Take total 761. Then remaining portion, these three lines are same, but goodwill figure will change. How much is that? 171. There is a note written below. When non-controlling interest is measured at proportionate share of net asset, the goodwill is popularly termed as partial goodwill. And in the first answer, the note was when goodwill is measured using NCI at fair value, it is termed as full goodwill. Okay. So these are some basic discussion because they will be required in every problem. Now we'll come to measurement. Profit or loss of subsidiary company. An entity includes the income and expense of a subsidiary in the CFS. Now, very important because I'm going to solve immediately after some time consolidation of profit and loss. And suppose the date of acquisition given is 1st July 2020 and your year ending date is given 31st March 2021. How many months are there from the date of control till the year ending date in this example? I think 9 months. So while calculating the income or expense of subsidiary, you will take 9 by 12. Or say for example, you lost the control here on 31st December 2020 only. You will consider the income and expense of subsidiary in the CFS from 1st July to 31st December, right? So from the date it acquires control until the date when the entity ceases to control the subsidiary. If suppose you are having an year ending date, then in that first year you will take proportionate calculation. So in every problem that you solve, what you should do, you should mark the date of acquiring the control, that is date of acquisition. In the profit and loss of subsidiary company, of course after making certain adjustments given in the problem like impairment of goodwill, unrealized profit or loss, okay, additional depreciation on revaluation, etc. After making adjustment in the subsidiary's profit, then divide the profit or loss and each component of other comprehensive income to owner of the parent and NCI. Is it right? So in the profit and loss statement, this working we'll have to do. We have to find out how much group profit belongs to NCI. If you can find one of the figures correctly, the other is the balancing figure. So we will find out this one, and then NCI total profit minus NCI share is the profit of the owner of the parent. Similarly, if you are also asked to prepare P&L account plus OCI, then I have to make two calculation. One, this one, profit and loss distributed between NCI and parent, and total income. Total income would be profit and loss plus OCI. Profit and loss plus OCI, that you distribute between NCI and the owner of the parent. Okay. So that also I am going to do in one problem. Now this standard says when you will apportion the gain or loss to NCI, it is possible that NCI may be negative. No problem. NCI can be negative also. NCI balance can be negative. Now I need to make one small clarification here. In India, there is an accounting standard 21. In this AS 21, accounting standard 21, which is applicable to certain Indian companies, if the NCI is negative, it is adjusted against reserve of the parent. This treatment we will not give, okay, in this chapter. Now one small example we will take where NCI will become negative, and then no problem, you have to just keep on writing the negative figures. A Limited had acquired 70% of the equity share of B Limited on 1420x1. 70% means NCI share is how much? 30%. It was acquired at a cost of 10 lakh. When B Limited had an equity share capital of 10 lakh and other equity of 80,000, in the 4 consecutive years, B Limited fared badly and suffered losses of rupees 2,50,000, 4 lakh, 5 lakh and 1,20,000 respectively. Thereafter, in 2005-06, B Limited experienced turnaround and registered an annual profit of rupees 50,000. In the next 2 years, that is in 2006-07 and 7-8, B Limited recorded annual profit of rupees 1 lakh and 1,50,000 respectively. Question is, show the NCI and cost of control. What do you mean by cost of control? Right there, goodwill or GOBP, but we will prefer to write goodwill only. Calculate goodwill and NCI. Now goodwill will not change unless it is impaired, but NCI will keep changing every year as the subsidiary earns profit or incurs losses. Assume that assets are at fair value. Now where will you apply assets are at fair value? For calculating the goodwill and NCI on the date of acquisition. Share capital is 10 lakh. Other equity is 80,000, which means if I apply share capital plus other equity route, my net asset is 10 lakh 80,000. Okay. So first you tell me, you will try how much is goodwill. Goodwill, try. How much is goodwill? Yes, come on, fast. How much is NCI on the date of acquisition? Check the NCI answer. Question says assume assets are at fair value. So you will solve like this, tick tick. Share capital 10 lakh, other equity 80,000, total 10 lakh 80,000. Therefore NCI 30%, 3,20,000. Come back to goodwill calculation now. How is goodwill calculated? Consideration paid for 70% share 10 lakh, tick mark. NCI 3,24,000 less identified net asset 10 lakh 80,000. Therefore check, is goodwill 2,44,000? Yes. Now let us write down NCI at the end of each year. Now you must have understood goodwill figure will not change unless it is impaired. Question is silent about impairment, loss of goodwill. So we'll keep the goodwill constant for those 6 or 7 years given in the problem. Now on the screen, check how to compute NCI at the end of each year. So first I will write NCI at the time of acquisition. How much was that? 3,24,000. In the year 2001-2, what is the profit or loss of this subsidiary? 2,50,000. Take 30%, 75,000. So NCI balance will go down to 2,49,000. Keep tick marking. Then next year 4 lakh loss, 30%, 1,20,000. NCI figure will reduce to 1,29,000. Tick mark. Come to next year 5 lakh into 30%, 1,50,000. Now the NCI balance is negative. Negative balance is also okay. Okay. 2,004.5. 1,20,000. 30%. 36,000. NCI balance minus 57,000. 2,005.6. Now there is a profit. 50,000. 30%. Positive 15,000. Therefore NCI balance 42,000. 2006-7. Profit 1,30,000. Still there is a negative balance of 12,000. 2007-8. 1,50,000. 45,000 and 33,000. Is it right? So this is how we compute it. Next paragraph is, will any further change in the parent's investment portion in subsidiary but not resulting into loss of control affect the goodwill? What do you mean by this paragraph? This paragraph means, suppose I am holding 60% share, I purchased another 20% share. So my share is now 80%. When I had acquired this 60%, goodwill was, say for example, 200 million. Okay. Will you again calculate goodwill for this 20% share? No. The standard says no. Another example. Suppose I am holding 60% share. I sold 5% share. So now I am holding 55% share. Still I have the control. Control should not be lost. Otherwise then we will have a different discussion towards the end of this chapter. Still I will not change the goodwill value. Why? Goodwill was paid at the time of acquisition. We paid for goodwill so that we can get the control over the subsidiary. We can get control over the resources of the subsidiary. If I add more stake in that company, it does not change my control. It only gives me power to earn more income proportionately. Or if I sell some stake, my proportionate share in the profit will come down, but my control still remains the same. So this standard has a different logic compared to what you have learnt in India, AS21. In AS21, if you buy additional lot, again calculate goodwill for that additional lot based on its cost and its share in the net asset on the date of acquisition, but that we don't do in this IFRS 10. So on further investment, the parent is not obtaining the control. Instead is only obtaining a higher share or maybe lower share in the income generated using the same resources. Hence goodwill is not affected. Now we'll come to preparation of consolidated SOFP. So maybe some points will get repeated. When we prepare the consolidated statement of financial position, the assets and outside liabilities of subsidiary companies are merged with those of the holding company or parent company. Equity, share capital and other equity of the subsidiary company are apportioned between parent and NCI. These items, along with investment of parent company in shares of subsidiary company, are not shown in the consolidated SOFP. What item will not appear separately in the consolidated SOFP? Investment in subsidiary will not appear. Share capital of, fill in the blank, dash will not appear. Share capital of subsidiary will not appear. What about the reserve? Reserve will not appear. Then how are they treated? The share capital is used for calculating the goodwill or gain on bargain purchase. Reserve is of two types, pre-acquisition and post-acquisition. Again, this pre-acquisition reserve goes in goodwill calculation. So investment goes in goodwill calculation. Share capital of subsidiary will go in goodwill calculation. Pre-acquisition reserve of subsidiary will go in goodwill calculation. And post-acquisition reserve is distributed between parent and NCI. Parent and NCI. And in place of investment in subsidiary, share capital, pre-acquisition reserve, what we get? If I remove these three items, what we get? Either goodwill or gain on bargain purchase. And then we also get one NCI, right? So these items will not appear as it is from subsidiaries book, but other assets, liabilities, income, expense will appear subject to some adjustment. The net amount resulting from various computation on these items are shown as under. One will get NCI, second will get goodwill or gain on bargain purchase, and third will get parent company share in the post acquisition profit of the subsidiary company, which will be added to the appropriate concerned account of the parent company. What is appropriate account? So if subsidiary has general reserve in the post acquisition, I will add it to general reserve of the parent. If subsidiary has retained earning in the post acquisition period, I will add it to retained earning in the post acquisition period. If subsidiary has, say, capital reserve, then I will add it to capital reserve of the parent if required. So any reserve, whatever name the subsidiary gives, I will add it to the corresponding reserve of the parent in the consolidation. Now this we have discussed, so can I skip this paragraph? If the entity makes two or more investment in the another enterprise, so that is step acquisition, then the date when you actually obtain the control, that is the date you apply IFRS 10. And then the previously held equity interest will be fair valued on the date of acquisition. And then compute the goodwill or capital reserve. Now we will solve. Come on. Question number 3. This is a basic question. Then slowly and slowly the level of difficulty will go up. Right? Two easy questions. Warm up exercise. Start. Black company acquired 100% share in white company on 31st December 2015. SOFP of black and white on that date were black, white, non-current asset. Under that tangible asset, investment, and there is only one investment, that is shares of white company 100%. So this problem will not have NCI. Correct? Loan stock of white, tick tick. Whether they tell you or not, if you find any intercompany receivable or intercompany payable, you will cancel them in the consolidation process. Then current asset, inventory, receivable, bank. Total asset, equity, ordinary share, retained earning, non-current liability, again tick mark, loan stock. But you will find this is 5,000, this is 10,000. So entire 10,000 is not from black. Only we will cancel 5,000 from both the sides. Is it right? Remaining 5,000 means that is a loan from some other party that will appear. Bank overdraft payable to prepare the consolidated SOFP. So in this question, first I will prepare one small calculation for goodwill. Right. Calculation of goodwill. Calculation of goodwill. Point A, write down consideration transferred 30,000. Point B, write down fair value of identified net asset. Fair value of identified net asset. Now in this question, are you given fair value of any asset or liability separately? No. So in that case, we'll apply this route. Share capital plus reserve plus change in fair value, but there is no change in fair value. So you go to the SOFP, you will find share capital of subsidiary is 16,000 plus retained earning is 12,500. Is it there? 28,500. So we will recognize goodwill 1,500. Now we will write one memorandum journal entry. What is memorandum journal entry? We do not actually record this entry in the books of account because parent is one entity, subsidiary is another entity. It's only for the purpose of understanding how the subsidiaries financials are consolidated with parent. So what I'm going to do, I'm going to take over all the net asset of the subsidiary. I'm not writing individually. You want to write? Understandable. All assets debit, all liabilities credit. So the net asset debit will be 28,500. Which means subsidiaries, all assets will come in our books now. Because of this entry, all liabilities will come. Goodwill will come 1,500. And that investment in our books, against this investment we got net asset of 28,500 and we paid 1,500 more than what we had received in the form of net asset. So therefore investment in shares of white company 30,000. So this is called consolidation entry or memorandum journal entry. It's only for understanding that this is the logic of consolidation. What has come? Subsidiaries, assets and liabilities, goodwill. And what has not come? Investment. And what has also not come? Share capital of the subsidiary and retained earning of the subsidiary. Why not NCI? Because we are holding 100% share. So now write down in the notebook consolidated SOFP of black company as on 31/12/2015. Okay. Draw this format first. Particular, rupees, rupees. 2 columns on the right side. Then write down assets. Under assets, write non-current asset. Non-current asset. Under non-current asset, write tangible asset. tangible asset 95,000, intangible asset under intangible asset write goodwill 1500 already calculated. Then write current asset. How did you get that 95,000? I hope you have understood. This is the total of the two companies' intangible asset. Investment, write down. You will not write investment. Then write down loan. Oh, loan will not write down. That also cancelled. Then we will write current asset. Take total of 10,000 plus 8,000. Inventory 18,000. Receivable 8,000 plus 9,000. 17,000. Cash at bank 4,000 plus 0. 4,000. Take total current asset in the outer column. Is it 39,000? Yes. Take total of asset side. Write total asset 1,35,500. 1,35,500 is right. Then equity and liabilities. Equity and liabilities. Under that write equity. Under equity write ordinary shares 73,000. I am not preparing SOCIE in this question because there is nothing much to be shown there. Otherwise, you can prepare one more format, SOCIE. For simplicity reasons, we have ignored that working. Then retained earning also will not change because the date of acquisition is 31st December 15 and the date of consolidation is also 31st December 15. No change in retained earning because there is no post acquisition retained earning of subsidiary. Okay? In this question, there is no post acquisition profit because subsidiary was acquired on the last day of the year. Then write down non-current liability. Under that, loan stock will have adjustment. 10,000 minus intercompany receivable and payable cancelled 5,000. Therefore, 5,000 in the outer column. Current liabilities. Under current liabilities, write down bank overdraft 3,000. Trade payable. Add 14,000 plus 10,500. 24,500. Correct? Total in the outer column 27,500. Now you take the total of equity and liability side. Does it come to 1,35,500? 135,500 is right. Say yes. Yes. Done. For the sake of simplicity, we have not prepared SOCIE. Because there is no adjustment, you have to write the same thing again. Again, copy the same thing here. Now we'll come to question number 4. Again, it looks little lengthy problem, but the question is same. Given below are the SOFP of P and Q limited as on 31/3/20 PQ non-current asset, property, plant, equipment, financial asset, non-current investment, loan, tick mark loan, tick tick, Then current asset, under that inventory, financial asset, trade receivable, cash and cash equivalent. Total asset, equity and liability, shareholder fund, share capital, other equity, non-current liability, long-term liability. Now you tick mark this item, non-current liability, long-term liability, and this loan you tick mark. Deferred tax liability, long-term provision, current liabilities, financial liabilities, trade payable, short-term provision, total equity and liabilities. Total equity and liabilities. Then notes to financial statement. Under that they have given reserve and surplus, general reserve, retained earning. If you see, this will match with the SOFP 1,20,000 and 40,000. And similarly, they have given you the breakup of inventory, raw material and finished goods. 20,000, 10,000, which is also appearing in the SOFP. Now see the adjustment given below. On 1420X1, P Limited acquired 30% of the equity share. 70% of the equity share. When did they acquire? 14, underline 1420X1. And what is the date of SOFP given to you? Let me check. Is it 31st March 20X1? How much is the gap between these two dates? 0. So it is as good as you have to consolidate the same SOFP. Okay. Waste of time. They could have written 31st March only. P Limited acquired 70% share, which is equal to 700 lakh out of 1000 lakh of Q Limited for 36,000 lakh. No problem. The company has adopted an accounting policy to measure NCI at fair value, that is quoted market price, applying IFRS 3. Accordingly, the company computed the full goodwill on the date of acquisition. Share of the both companies are face value of rupees 10 each. Market price of Q on 1/4 is rupees 55. Now it is written entire long-term borrowing of Q Limited is from P. So I am going to previous slide to check how much is that figure. Entire long-term borrowing of Q means 10,000 is from P, means this 10,000. So this 10,000 which I have highlighted, this 10,000 we will cancel them. That is the only adjustment you have to do, like previous problem. Nothing different from previous problem. Previous problem the NCI was not there. In this question NCI is there. This is the only thing which is different. Entire long-term borrowing is from P. Fair value of net identifiable asset is rupees 50,000 lakh. Let us check whether it is different from book value. On the screen, share capital is 10,000 and other equity is 40,000, which means this line is of no use. Fair value of net asset is same as book value. So like previous problem we will solve. First you draw the format. Now how do you present the answer in the exam? First you will draw the main format and then you do some working notes required. So write down, dear students, consolidated SOFP of P Limited as on 1420X1. The date of acquisition and the date of this SOFP both are same. Like previous problem, there is no post acquisition profit or loss here. Write down format, same format like your question book. assets, non-current asset, property, plant, equipment. Only one line you will insert there. Intangible asset dash goodwill. Because you may get goodwill in the process of consolidation. One line blank, financial asset. Under that write non-current investment. Now this non-current investment is different from what you have acquired, because that is not appearing in this balance sheet. That was acquired on 1st April. Correct? So this may be some other investment, so that will continue to appear. This loan will get cancelled. So loan you can ignore. Current asset, inventories, financial asset, trade receivable, cash and cash equivalent, total asset. This is only asset side. One line blank. Now write down equity and liabilities. Equity and liabilities, under that you write down share capital, then write other equity, then write non-controlling interest, NCI, then write non-current liabilities, under non-current liabilities write financial liabilities, under financial liabilities write long-term borrowing, then write deferred tax liabilities, then write long-term provisions, one line blank, current liabilities, then write financial liabilities, then write trade payable, then write short-term provision, and after that write down total equity and liabilities, Total equity and liabilities. Now write down below that one small format, consolidated statement of changes in equity. You can write consolidated SOCIE. Then draw this format, share capital, general reserve, retained earning, NCI, group total. And just write down one line first, opening balance as on 1420x1. One more line blank, total. And then we'll prepare just one small working and then start consolidating. Okay. So dear student, write down below that working note 1, computation of goodwill and NCI. First, I am going to give you 5 seconds to try. 5 seconds starts now. What is goodwill? Answer? Huh? Is it 2500? Write down. Fair value of purchase consideration given in the notes below the SOFP 36,000 given. Then fair value of NCI we have to calculate 300 lakh share into market price 55. So which is 16,500 less fair value of net asset which is given 50,000. So therefore goodwill 2,500. And in the process NCI also we have found out 16,500. Is it right? Now let us complete the answer. Start, help me. You have calculator. Property, plant, equipment. How much is the total? 1 lakh? 51,000. How much goodwill you got? 2,500. How much is the non-current investment? Non-current investment is 10,000, no? हाँ 5 plus 1. अच्छा. 10,000 is the loan. Loan will not come. Then inventory 30,000. Trade receivable 18,000. Cash and cash equivalent. Total of the asset side 246. Sure. So everybody write down 246,500. Right. Let us try share capital. First come to SOCIE. In SOCIE, share capital write down only parent company. How much is that? And parent company's general reserve is how much? 1 lakh. And retained earning is how much? 20,000. General reserve is 1 lakh and retained earning is 20,000. Right. And how much is the NCI on date of acquisition? How much NCI you have found out? Okay. Do we have any post acquisition profit in subsidiary? No. So you can take the total of this working. Okay. 20,000, right? Total 1 lakh. You can avoid this working note in the exam, but such questions are not asked only. Okay. So total of the last column is 156,500. Correct. Now how do you present it in the main page? This 20,000 write share capital. These two total you write down in other equity. And this you write 16,500 in NCI. So write here. Share capital 20,000. Other equity was total how much? 1 lakh? 20,000. And NCI was how much? 16,500. Now what about the subsidiary share capital? Subsidiaries other equity? Both 50,000 we have written in that goodwill calculation. So that 10,000 and 40,000 total on the screen, this 50,000 which is there, Is this 10 and 40 only? Now you write down borrowing. How much borrowing you will write here? 30 plus 10 minus 10. 10,000 will get cancelled. 10,000 cancel, it is group company dues. Deferred tax liability total. Current liability, financial liability, trade payable total 8,000, and short term provision total 4,000. So what is the total of this side? Total of this side. Long term provision total is how much? 6,000. Is it not telling? Wait. Cash and cash equivalent. How much amount was paid to acquire the shares? 36,000. Is the difference 36,000? Because this cash will be used, no? So make a small adjustment in this cash calculation. You are given a balance sheet of 31st March and you are preparing on 1st April. So we have used cash out of 38,000 minus 2,000 minus 36,000 plus 1,000. How much it gets? 38 minus 36 and plus 1. Is it 3,000? Now tell me the total. 210. What is the liability side total? Yes. 210,500. Because the purchase entry is not appearing in the given SOFP. Tallied. Yes. Come back to your book. Next paragraph is accounting policies. What should be the accounting policy of the group? Same or different? So ideally, the subsidiary should follow the same accounting policy for same or similar transactions as it is followed by the parent company, so that all figures are based on uniform accounting policies. Numbers are easy to compare, okay, add, analyze. CFS shall be prepared using uniform policies. What if they follow different policy? If a component of the group applies different policy for like transaction and other event, then adjustments are made to reflect uniformity. So that means you may get some questions where they might ask you to make adjustment for the difference in accounting policies. Now one small example, first read on the screen. Only read on the screen, then we will discuss. PQR is a subsidiary of MNC. In the standalone financial statement, PQR has adopted SLM and MNC has adopted WDV for depreciating its PPE. As per IFRS 10, a parent shall prepare CFS using uniform accounting policies for like transaction and other events in similar circumstances. How will this PPE be depreciated in the CFS of MNC Limited? So that you have to answer whether it is changing, whether it is different accounting policy or different estimation. So can they follow two different methods of calculating depreciation? Yes. First of all, method of depreciation is an estimate. Next is the standard IAS 16. They have permitted you to follow different methods of depreciation for different classes of asset. Okay. So if their use is different, the nature of the asset is different, then you are allowed to follow different accounting policy for PPE item. So if they can demonstrate that the purpose, use, nature of the use of that PP is different, they can continue to follow SLM in the books of one party and WDV in the books of other party. So this way you have to present the answer. Don't jump to the conclusion and say, now the subsidiary also has to follow WDV method as per parent. You will write like this: as per IAS 16, a change in the method of depreciation will be accounted as change in accounting estimate, which is as per IAS 8. Therefore, the selection of method of depreciation is an underline accounting estimate and not an accounting policy. The entity should select the method that most closely reflect the expected pattern of consumption of future economic benefit embodied in the asset. That method should be applied consistently from period to period unless there is a change in the expected pattern of consumption of those future economic benefit in the separate financial statement as well as CFS. Therefore, now underline again, there can be different method of estimating depreciation for PPE if their expected pattern of consumption is different. Okay. The method once selected in the standalone financial statement of subsidiary should not be changed while preparing the CFS because it is not an accounting policy. It is a method of calculating the estimate of depreciation. So hence, in the given case, PPE of subsidiary may be depreciated using SLM and PPE of parent may be depreciated using WDV if such method closely reflect the expected pattern of consumption of future economic benefit embodied in the respective assets. Okay, now we will take a break.